With me live from Dubai is Ziad Awad, the CEO of Awad Capital Limited. Ziad, welcome. Do you agree with these recommendations to replace U.S. bonds with global bonds because the Fed won't be able to cut interest rates like its counterparts from global central banks?
The answer to this question depends on the type of investor. There are dollars invested in global bond markets. Some of these mandates can make that switch or arbitrage between US bonds and European bonds based on their mandates. But the possibility of deviating from the benchmark for these bonds isn't high. The decision to engage in a fundamental trade in US bonds isn't easy. And today, US bonds have higher yields and a stronger dollar. Also, the biggest factor impacting returns post-yield difference is what will happen with the currencies. In my opinion, the answer to this isn't straightforward. The possibility of moving away from the benchmark for these bonds isn't great. The decision to make a basic trade in American years isn't easy. And today, American years, the yields are higher and the dollar is stronger. Also, the main factor affecting returns is currency changes. In my view, the answer isn't easy, and I'm not positive on European bonds.
Before I move on to European bonds, Ziad, what did we understand from Powell's statements yesterday? He says that the U.S. economy is now stronger than it was when he started cutting interest rates in September. Is he preparing us for strong numbers from the job sector tomorrow? Could he be starting to give signals about the possibility of a rate cut in the December meeting? Despite that, the markets are still pricing in a probability of over 70% for a cut in December. What do you think?
So I read what Powell said yesterday, and also what several of his colleagues, the heads of the Federal Reserve banks, mentioned in the past few days. The market is right to expect a decline in December, but the bigger expectation for next year is that there will be fewer cuts, and maybe there will be a pause rather than a cut in every meeting. So the market's assessment is at 70%, and I have no problem with that. But for sure, the US economy is strong, and inflation hasn't yet reached the level the Fed wants. However, we shouldn't forget that the interest rate is still high, and we shouldn't overlook that the interest rates for 10-year and 30-year bonds have gone up, not down. More than 50 strong points since the last hike of 75 points, which means that monetary conditions are still restrictive in America, especially not just for companies, but for families trying to buy new homes and so on.
Ziad, let me go back to European bonds, these negative political developments in France. And let's not forget that the political situation in Germany is also unstable. So how do you read the implications of that on the euro and European bonds?
Discussing the spread between French bonds, German bonds, Italian bonds, or Portuguese bonds, note all these countries have strong deficits and their economies are very weak. Thus, comparing two weak economies and two economies with political issues, hence, discussing the spread, consider the spread between what and what. Also, consider the absolute level of yields. Yields at 3% are very attractive, so investors should be cautious.